is with us. He's a senior investment strategist at Standard Chartered. Rajat, good to have you with us here. Thank you very much for your time. So, the Jackson Hole has come and gone, and markets in the US at least are up since then, 2% or so since that event. Is it looking a little clearer, or is it still hazy in terms of what happens next from here? Implications for equities.
Yeah, morning, Prashant. I think Jackson Hole, as you said, was mildly hawkish, if I put it that way, neutral to hawkish. Now, both Powell and Lagarde from ECB were data-driven, right? So they've clearly said that they're ready to raise rates. They're still focused on inflation, but a lot depends on the data going forward. And that's, in terms of data, there are two things that we need to watch. In the US, how the job market behaves, and in Europe, how the inflation behaves. So this week is a crucial week, as you pointed out. In the US, we have the job openings coming up tonight, and then you have the non-farm payrolls. Now, in terms of the job openings, that's going to be critical indicator for what the non-farm payrolls data comes out. I'm looking at the hiring rate. The hiring rate has been falling, and if that continues, it points to a fourth month of probably below expected non-farm payrolls. As we know, non-farm payrolls have been missing the expectations for the last 3 months. So if that continues, that miss of job payrolls continues, we could see the Fed pausing in September. And in Europe, I'm watching the CPI data coming up. Inflation is clearly higher there than in the US, and we need to watch, whether that downtrend. We are seeing a downtrend in headline CPI, but not so much in core CPI. We need to see core CPI fall. If core CPI remains elevated, we could see another ECB rate hike. But we are getting almost close to the end of rate hikes in both US and Europe.
Okay, we're getting close to the end of rate hikes in US and Europe. That's actually very good for equity markets, right? Because, I mean, we've already seen a good amount of rally. The Indian markets, for example, the Nifty is up 7% this year, but the mid-cap index is up almost 25%. So there is a broad-based rally that's playing out in the Indian markets. Do you think that's something that can continue, and would you dip your fingers further here?
Yeah, in India, the story is slightly different. In the US, like I mentioned, in US and Europe, the narrative is between higher for longer rates and that recession story that never goes away. In India, growth is actually picking up. So we see a further pickup in growth in this current fiscal year. In fact, the latest quarters are going to show pickup from the last quarter. And corporate profits are strong. I mean, the only question in India is, of course, this valuation. And as we know, valuation has also come off a bit. So in terms of positioning for India, I think we've mentioned it before, it's a structural story. And if growth is supportive, if underlying economic growth is supportive and corporate earnings growth is supportive, India is going to stand out in terms of the global environment. I must mention also that we've seen FI pick up in India, right? And they're realizing this structural growth story. So if you see just I look at, let's say, MSCI ACWI index in the world, and India's share in that MSCI equity index is just 1.6%, right? It's a tiny fraction, but India's GDP in global terms, in global GDP terms, is almost 3.5–4%. So India is underinvested in global portfolios. That's another factor that is driving India.
All right. Hi, Rajat. Good morning. Rajat, what about the Chinese markets? They are making steps. They're trying to make some moves to rekindle or, try to push back the interest in their capital markets. Also, China's trading at half the valuations of India, maybe for a reason. But in the near term, do you see some money flowing towards China?
Yeah, so China is, challenged in terms of the economic trajectory now, right? So they're trying their best, but it seems like the market is not convinced that monetary policy easing that has happened so far, they've done a few rate cuts, is not good enough. So the market is looking for fiscal policy, fiscal stimulus. But it looks like Chinese authorities are not willing to go the whole hog this year, because they're going to meet their growth targets, the 5% growth target for this year. And that's because of this base effects playing, right? China is coming out of that lockdown this year. So they are going to meet the 5% target, and authorities are not willing to go the whole hog to do that fiscal stimulus that the market is expecting. So it's a bit challenged there. But to your point, valuations are in China are almost half of that of India or half of that of the US. So if you are a long-term, if looking at the 1 year horizon or 2 years horizon, you probably will not go too wrong investing there. But there are challenges coming through because of this economic the story that is needs more and more fiscal stimulus.
Okay, we leave it at that. Thanks for your quick take on the market. Rajat, appreciate your time here. Let's slip into a quick break. On the other side, we'll have our